We are in our final week of quizzes and CPA prep, but probably more poignantly, this is the last class session that I get to teach you all something new. Yeah, everybody says I'll still be learning lessons from Dr. Barnes. I refuse to give you any more lessons after this. You to teach you anything new. You're going to ask me a question about something, I would say, well, refer back to my previous lecture or my previous lesson. Even in casual conversation, I'm not going to give you new facts. I'm just going to refer to facts that you already know. So, yeah, kind of a sad moment for me, but I'm excited for what you all are going to move on. I guess if Alex and Isaac were here, they're playing baseball because this is perfect baseball weather. But if Alex and Isaac are here, I say they've got still the opportunity to learn something new next semester. But everyone's in the room right now. We are done after today. So I want you to savor this moment. Every single time we go over a CPA question, it says, that's one fewer CPA prep question that I get to do with Dr. Barnes. It's a little bit sad, a little bit dying a little bit inside. All right. You think I would actually do some good CPA prep questions, but these are awful. Yeah, these are awful. Just as a reminder, we start our case or our research project presentations on Monday. I believe it's the front row group that's doing it on Monday. Then back there is Wednesday, and then back row groups Friday. I'm putting you in the back row group, Tyler, even though you sit further forward than anybody in the class. All right, that's the response I expected. Okay. And then, we will be meeting for finals week, but it'll be an informal meeting, kind of like we did for advanced AIS. I'll bring orange juice and food. And again, the same rule holds for the orange juice. No, don't ask, no tell. I'm not gonna judge whatever you got. It is 9:30 in the morning, so maybe you want to kind of keep it to pretty mild stuff. But again, no judgment. Which of the following circumstances requires modification of the accounts report on a review of interim financial information of publicly held entity prepared on the basis of generally accepted accounting principles? So the rules surrounding review modifications are pretty consistent. Usually there's only going to be two situations where we will modify a review. So the first of these is not really relevant to this question, but it's probably important for you all to know. It's going to be if there's a going concern issue, which makes sense because if a going concern exists, then probably stakeholders who are involved in the organization would like to know they may not be in business a year from now. What is possibly the other situation that we could actually talk for a modification? Departure from something. We've heard this before.
Yeah.
Anytime we have a departure from GAAP, we're going to have a modification or review report. So let's go through the answers. Okay. So an uncertainty, this kind of automatically disqualifies it because an uncertainty is not a departure from GAAP, just as it says an uncertainty. Lack of adherence to GAAP, that's true. And lack of adequate disclosure, that's also true because adequate disclosure is required under GAAP. So the uncertainty kind of disqualifies A. Lack of adherence to generally accepted accounting principles, all right, departure from GAAP, and lack of adequate disclosure, also departure from GAAP. So B is our answer. We can eliminate C and D because they all include portions of the answer, but also include additional items. I guess C is saying none of the above items, which some of the above items would actually qualify as departure from GAAP. So B is our answer. According to the profession's ethical standards, an auditor would be considered independent in which of the following instances? So I know there's a few people who've already taken an audit, and I think they will probably confess that you are going to have to know the independence rules pretty well. It's always on every CPA exam, so make sure you got familiar with Code of Professional Conduct. So let's go ahead and go through the examples. Which of the following would an auditor be considered independent? So in other situations, which of the situations is independence not violated? The auditor is the officially appointed stock transfer agent of the client. So the question that you would always ask in this situation is, would I be put in a position, if I'm the auditor, would I be put in a position where I'm auditing my own work? So is this a situation where you'd be auditing your own work? It would be, because if you're a stock transfer client, you probably would have to send out confirmations or at least gain information from that party. So you'd be saying, I'm sending confirmations to myself, which seems kind of ridiculous, and it is. So I would not be independent. Auditor's checking account that is fully insured by a federal agency is held at a client's financial institution. So is this okay? This fine? Yeah, this is okay because you do not have any over-reliance or dependence on the client. If the client goes bankrupt, it's inconvenient for you, but you're still going to get your money back. Again, with independence, we're worried about compromising situations, and this would not be a compromising one because you don't have any worries about whether or not the client is going to face business adversity. So B is our answer, but let's go through the rest. The client owes auditor fees of more than 2 years prior to the issuance of the audit report. What's the threshold for owing the fees, past due fees? Yes, okay. And generally speaking, we're talking about whatever that's going to be a period of a year. And the logic behind that kind of holds with we talk about financial accounting. Remember from 303, I know it was a long time ago for many of you, but remember from 303, what happens to a short-term payable if it gets older than a year? Becomes a long-term payable. And so if we're talking about a note, what's implicit with a note, or what do you have to impute on notes? Interest, okay? Even if they don't have actual interest, you have to impute it on the note because that's relevant. So you're basically a credit holder in the client you're auditing, which means there's an ownership interest. That's the logic behind that. Client's owning tenant in the commercial building owned by the auditor. So basically you have a business relationship with the client. That would kind of be an issue. We call that something like a related party transaction, but that's not really what we're dealing with here. Because if we're talking about two independent parties, we're talking about this situation, the auditors basically are got a pre-existing relationship, which could be adversarial in that situation. So D is obviously going to be disqualified. So B is our answer. The Code of Professional Conduct Independence Rule does not consider the following circumstances to be in lack of independence. All right, so let's just go again through the answers. CPA firm's sole audit manager served as controller of the client's firm's audit client from January year 1 through May year 5 when the manager began working with the CPA firm. Current audit period for the client is April 1st, year 5 through May 31st, year 6. So look at this right here. If we're talking about those, we've got a little bit of an issue here because if you notice that when the current audit period is overlaps with when the CFO or the sole audit manager began working with the client. So in fact, it's only a month, but they're still going to be, or maybe 2 months, depending on how you look at it. But it's only a short period of time, but they're still going to be auditing their own work, which we know is a violation of independence. I love this next answer. The auditor's brother-in-law's father is the controller of the client being audited. So we've talked about immediate family member relationships and close relationships. Is this close enough to be considered to be a lack of independence? Not really. It's probably a little bit suspicious. You'd be like, well, we got to be very careful. But from strictly speaking, this is not a close enough relationship to impair independence. The brother-in-law's father. All right. So B is our answer, but let's go to the rest. The audit firm is privately held, and the auditor provides valuation and appraisal services to the client that are also which are material to the financial statements. We know if that situation, if we're talking about other services, that if they're material and have an effect on the audits, that's going to be a violation of independence under ACCT guidelines. And then financial institution client loans auditor money by a vote, but does not collateralize the loan. So for the reasons that we talked about why the auditor was in the clear in the previous question, this is the reason why the auditor is not in the clear. So if there's a problem with the client, then their loan may become immediately due, and they may be saying, I don't want to face those consequences. I don't really have a collateral to face the loan or to guarantee the loan. So this is going to be a problem for me. So it may adversely affect the results of the audit opinion that I issued. So this would be a violation of independence if that was the case. So B is our answer. In reporting on internal controls, the Sarbanes-Oxley Act requires the CEO and CFO to sign the report to assert they have disclosed. Now, this is one that's more of a remembering and understanding rule, but I think you can come to the correct answer on this one, even if you don't know what the rules are here. So let's just go ahead and go through the answers, and let's talk about what the logic is behind this and how we should approach this question. So material fraud by management to the issuer's auditors only. Now, does that make sense that if there's a material fraud and management becomes aware of it, that the only party that they're going to notify is going to be the auditors? The stakeholders want to have information in that. Yes, and so this is probably one of those ones that external disclosure would be required. In fact, it is. So this would just be a limited disclosure of information that's probably relevant to other parties. So yeah, we can kind of disqualify it in that regard. All significant internal control deficiencies to the internal auditors only. So we know that the auditor has to report significant deficiencies to the audit committee. Wouldn't the same be held true for the management team as well? That would be a little bit weird if the auditor said, yeah, we have some significant deficiencies we identified here. Management will tell you more. The management team's like, nope, we don't know anything. That seems a little bit suspicious. So that's going to be disqualified. That any fraud by any employee to both the audit committee and the issuer's auditor. So what do we know about absolute statements? be very careful of absolute statements. So any fraud by any employee. So an employee stole a paperclip. Got to report that to the audit committee and to the auditor. Yeah, that's going to be one of those ones that's really extreme. But yeah, we know that that's going to be a little bit ridiculous. So fraud that has a direct and material effect is what I'm not primarily concerned with. That does get reported externally. All significant control deficiencies to both the audit committee and the issuer's auditors. That seems mostly consistent with what we know. So again, this is the answer based on the facts and circumstances. But if you didn't know that, then you can kind of logic your way to this as being the best answer. So for the reasons we talked about. This one's a true remembering and understanding question. How many audits of public companies does a CPA firm registered the PCAOB have to perform in order to be subject to mandatory annual inspection by the PCAOB? How many is that? 100. Nice round number. Somebody know about approximately how many firms are registered with PCAOB, or sorry, have over 100 client audits? So it's roughly right now, roughly 1,000 firms. Okay, I believe what it is. So here's an interesting question. So firms can actually be inspected either annually or triennially. I believe that's the guideline. So once a year or once every 3 years. Only the largest firms actually get inspected annually. So we probably can say at least 4 firms we can guess are going to be inspected annually. It's actually a larger number than that. That number is closer to around 12 to 15. It varies from period to period, but it's not a large number that gets inspected on an annual basis. All right. I don't have a good one for you in this one. This is just a blurb of information that's in Becker that you just kind of have to learn the information. It's not difficult. I would make sure you review it before you sit for the CPA exam. But if you're asking for approach on this one, this is, first of all, not something I teach. Secondly, I don't know what the best way to teach it others is. Just make sure you're familiar with the guidelines. So which of the following is not true about the Department of Labor's independence guidelines? So let's go with B, independence guidelines rendering opinion about apply to rendering opinion on both employee benefit plans. Yeah, that's one of the big actual focuses of the DOL guidelines. Independence guidelines prohibit the account from maintaining financial records for the employee benefit plan. That makes intuitive sense. Okay. That one's one we could easily eliminate because that would just, again, be one of those ones that would be a violation of responsibilities. They're not compatible with one another. Former employee of the plan may be employed by the accounting firm. I don't know how you know this unless you knew the guidelines, but that's actually a correct statement. That's true. A former plan person can actually be employed by the accounting firm. So that leaves A. An immaterial direct financial interest in the plan does not impair independence. That sounds like it would be correct, right? But the guidelines rules say that any financial interest is going to be enough to impair independence. So that's one of those things that you have to know about. So A is the answer, but again, if you did not come up with A, I wouldn't sweat it too much. This is not likely to be a big part of the exam. I say that, and then probably Jared and Troy are going to say, we had 2 task-based simulations on DOL guidelines, and no, didn't have that. Okay.
Yeah. I feel like they just try and throw in Department of Labor in there, just like throws you off. Because if you look at like the immaterial direct financial interest, it's like that does kind of look like a wrong statement.
Mm-hmm. It's again, I threw this question in there because it was one of the sections, and I tried to make sure there was at least one question on each section. But again, this would be one of those ones that if you're planning and you're trying to be strategic, you could say, I'm just going to punt this, and if I don't get the question right, I got a 25% chance to guess. Seems very unlikely there's going to be a task-based simulation. I'm not encouraging you to do that. I'm saying if you're doing it strategically. My encouragement would be that when you're preparing for all sections of the CPA exam, you do the Becker work and you get to test day ready, exam day ready. That would be my encouragement. But again, I don't know what's going on in your life. You may have like problems in your apartment with like roaches, and so you're having like things that are distracting. This is the hypothetical, purely hypothetical. All right. Everything get resolved?
No.
Oh, okay.
It just goes to me.
Boy, that's just me hitting below the belt. Things do not get resolved, and I still bring it up. Man, I'm sorry, Brett. No take backs on evaluations. Okay. So here we go. We've got some situations where we got ACCT code of professional conduct violations or no violations, and we're gonna, if there's a violation, we can actually select the violation from the list. If not, we leave it blank. So we're going to change the guidelines on this one. We are going to identify whether there's a violation, but we're going to identify the associated rule regardless of whether there's a violation, because I think this is just good clarity. So I do think that there's it's important to understand the code of professional conduct, not just from an independence perspective, but also make sure that you have the other rules down as well. I think that will be very prominent for you. So continuation of the new main use Jones and Associates CPA. So let's just go ahead and take a look. This is going to be on Exhibit 2. So for a fourth consecutive year, all employees are members of the ICPA. So they can they use the name Jones and Associates CPAs? Yeah. If all the associates are CPAs, all the people who provide client delivery work to the client. Now, it doesn't have to be every single person in the organization. We're talking about people who actually provide work for the client, provide meaningful work for the client. So that's no violation there. But we're going to be talking about what's the rule that's relevant here. Not the rule is violated, but the rule that's relevant here. What are we talking about? If I say form of organization and name rules, does that sound appropriate? Yeah, it seems like it'd be pretty appropriate there. HMC gift to the audit supervisor. So let's go ahead and take a look and see what the gift was. All right. I think AMC or HMC is very happy with work. The controller just gave me a $20 gift certificate to use for lunch at a local restaurant. All right. So I honestly have not looked at the recent guidelines. Back last time I remember it was $50 or greater was what the violation of independence is. Can you refresh my memory on that one, Troy?
Sounds all right.
That's about right. If it's not, we could say that $20 is probably not a material basis just by justification of the fact that it doesn't sound material. But it used to be $50. Again, don't take my word for it. This is not one of those ones that I'm going to be saying it's factually correct that it's $50. I'm saying it is around $50 last time I checked. But again, anything below that is not considered to be independent or a violation of independence, which kind of gives away the rule that was violated. But in this case, there's no violation, and we're talking about the independence rule. All right. Failure to return HMC's receiving reports. So let's go ahead and take a look at Exhibit 1. So as you know, in our review of the staff work, it's not good. Let's look at the actual advantage. So, HMC notified me that the audit staff is now returned to receive reports provided by the client despite numerous requests. Okay. So the response by the senior was, I believe the audit staff transferred another location, which is why they may not have responded. So, okay, we understand the reasoning behind it, but is there a violation of code of professional conduct here? Yes, there's absolutely a violation of the code of professional conduct. That is a big no-no when the client says, return our documents to us, and we fail to do so as auditors. And it's a specific example of one rule. And I said, this is the primary example that they talk about in the CPA exam. I've never seen another example of this particular rule used in any other context. Which rule is that? Acts discreditable. Acts discreditable. Yeah, acts discreditable is one of those ones. So again, are there other ways that you could discredit yourself as a CPA? Probably. I don't go challenging that. But this is the one that kind of appears so much on the CPA exam that you do need to be familiar with this particular example. All right, use of a non-GAAP depreciation method. Let's go ahead and take a look at the rule. All right. I discussed the non-GAAP method with both the in-charge partner and HMC management. We determined the company's method for depreciation is acceptable given the unique industry is necessary for HMC to avoid having misleading financial statements. So this one's an important note because we know this is an accounting principle rule because they're talking about accounting principles, but is there a violation here? They're not following GAAP, guys. Is there a violation here? No, there's no violation. There's no violation. I tricked you all. I tricked you all into coming to my answer. So keep in mind here that if we do believe that it's appropriate to not follow GAAP in a given situation, the client did not follow GAAP, there are reasons or there are acceptable departures from GAAP. It has to be confirmed by both the client and the auditor that it's appropriate to do so, because otherwise it would be misleading for users of the financial statements. And all those elements are given in the response, are given in the answer, the reasoning behind that rationale. So all of those elements are present. So this would be one of those ones we say, okay, this is a unique circumstance where departure from GAAP is justified. So it's not a violation of the accounting principle rule. Audit seniors lack a review of post-planning work papers. So let's go ahead and take a look at the audit senior. So I reviewed the staff's work during the planning stage. So due care and adequate knowledge. Well, that's good. So make sure it did work. So as a result, I did not review work papers during the rest of the engagement due to the high level of confidence I have in our support staff. All right, so you all are going to go out and you're going to start working and you're going to work for a senior associate. And they're going to diligently review your work during the planning stage. And then the rest of the audit, you're on your own. They're just like, yeah, I'm not going to bother reviewing. I know you're doing a good job. That sound problematic to anybody else in this room? Like, man, you guys got master's degrees. Obviously, you're going to know exactly what you're doing, right? Yeah, I wish that was the case. I felt like a fish out of water my first year for sure. I got it together second year. This is going to be a violation of the general standards rule. General standards rule has multiple components. One of those is going to be adequate supervision and planning. And so that safe supervision was violated for sure. All right, confidential information provided by an in-charge partner. So let's take a look. Oops, Exhibit 3. So this is lawyer. So lawyer, that's how we start out letters. We say lawyer. That's whenever I talk to Professor Templeton, I say, hey, lawyer. Yeah, yeah. So in response to the subpoena, June 1st, year 4, related to the pending lawsuit agency attached, please provide the requested confidential documents. So that word confidential probably gives you a clue as to what the rule that we're talking about here is. So we're talking about the confidential client information rule. Well, it's confidential, so is there a violation here? So what are the circumstances surrounding the disclosure of confidential information? What was another key word here? I'll give you a hint. It's the 5th word in the response. Subpoena, okay? If it's required for a regulatory review, so if like the PCAOB requested the information, or in response to a legal summons, subpoena, then it's fine to disclose confidential information. In all those situations, it has to be kept confidential. So you do have to look at the facts and the circumstances of the situation and say, yeah, they were required to do so under law, therefore no violation. This one's a really good one. I think this is a good indicator of the type of question you need to be asked in this area for code of professional conduct. So hopefully you get a lot out of that. All right, our last problem for the semester. Jared's not even here. What do you think? Since he missed that entire problem, what do you think? I should just allocate his points for this assignment to you all, give you all extra points, and then Jared just takes the 0, just takes the goose egg. He's had enough victories this year, so take it away. Yeah. All right. So we're talking about some rules that we're talking about SOX laws, Sarbanes-Oxley rules. So we're going to determine whether or not certain items are Sarbanes-Oxley compliant, and then we'll talk about why. So the CEO established an audit committee 3 years ago. The audit committee consists of CEO's brother, a middle school accounting teacher, his daughter, college freshman majoring in finance, his neighbor, a retired school bus driver, his accounting firm at college, who's now a CPA and a partner in a national accounting firm. Kind of did that and transposed those. College professor becoming a partner, that's weird. All the audit committee members are members of the board of directors. The CEO pays a small salary to the neighbor and the daughter to compensate for their time. Brother is a 30% owner in stock of Holcomb. Wow. Is this Sarbanes-Oxley compliant? No. There's about a dozen different reasons why this is not, but let's see if we can break this down. So what are some reasons, okay? So what are the rules with audit committee compensation? Not allowed, okay? The only thing that they can actually receive compensation is for their role on the board of directors. They can't receive additional compensation for their role on audit committee. So that's an important note. What do we know about affiliation? So we know that the audit committee cannot contain people who are managers of the organization, but there's also some rules about be able to be in a position to influence the client. If you're in a position to heavily influence the client, can you be on the audit committee? Like say, for example, if you have a 30% stake in the organization. Guess you where I'm going with this. The answer is no. Yeah. So the position to influence the client adversely is that would be a situation that you could not be on the audit committee because that would actually unduly influence your evaluations. 4 years ago, the CEO hired a top 10 national accounting firm to do the audits. The CEO plans to continue to oversee the audit firm work now that the Holcomb is Incorporated is totally held. The CEO meets quarterly with audit senior manager to keep the auditor apprised on what's going on in the company. So far, the CEO is happy with the work of the audit firm and the senior manager and plans to maintain that relationship. Well, seems like a pretty convenient setup. So is there any violation of Sarbanes-Oxley here? Yeah, pretty big problem. We are not compliant with Sarbanes-Oxley here. Okay, not compliant with Sarbanes-Oxley here. So who does the auditor supposed to report directly to? Is it supposed to be the CEO? No, didn't we talk about this just a second ago? What is the name of that body that they report to? The audit committee, yes, you weren't even here and you answered that question correctly. Good job. Were you standing outside the door listening? Okay, all right. They have to report to the audit committee, okay, so, and why is that the case? Because management and audit committee are always not always gonna see eye to eye, remember? Audit, or so management and the auditor are not always gonna see eye to eye. The auditor is the representative of the client, trying to make sure that they get and they're not the clients, the stakeholders, the stockholders of the organization, to make sure they get adequate financial information. So they report to the audit committee and represent the audit committee. So the audit committee oversees all disputes between management and the audit committee. So it's important to have that independent body. Based on the recommendation of the Human Resource Director, CEO established an employee hotline for reporting any concerns employees have regarding accounting or auditing our internal controls. A concerned employee called a third party, Watson Whistleblower Services, and reports the area issues. A Watson employee gathers information confidentially. Employees are allowed to report anonymously if they wish. Information is then communicated to the board of directors, which includes the CEO. Watson follows up with the CEO and board periodically until the issue is resolved. Okay, what do y'all think? Is this SOX compliant? I got one thumbs up. Everybody else is looking at me like, you're going to tell us the answer. Stand here, never give you the answer. You're going to be in suspense. Okay, I got two thumbs up. Do we have third? Do we have any thumbs down? All right, no thumbs down. So we're going to say yes, and yes is correct. Okay. So the rules around that saying that procedures must accommodate confidential, anonymous reporting by the employees of the user and must accommodate receipt, retention of complaints, as well as a method to address those complaints. So all of those elements are present, so we're good here. All right, the CEO and the CFO sign required representations about the annual report. The representations make a number of statements, including the following. Internal controls have been evaluated for effectiveness as the date of 6 months prior to the report. Are we SOX compliant here? A lot of bit of certainty. I got a thumbs down from the corner of the room. All right, this is not SOX compliant. All right, this is not SOX compliant. We're doing really good up until we get to the end, because there are certain representations about the annual report. They have to make another statements. So their internal control deficiencies have been evaluated effectiveness as the date of within
60 days.
And so 90 days. Yes, 90 days of the report. Yeah, that was the idea. So yeah, I couldn't remember either. I had to look at my cheat sheet. So good points.
I just remember getting that one wrong, and I was a little bit upset about it. So.
As you should be. As you should be. Get unhappy about when you get. I always beat myself when I get a question wrong. I have to go feel like one of those scouring that you did, like with the whip and everything. Because whenever I get a question wrong, my back is terribly scarred. So, all right. Wow, we're really off the rails today. Really off the rails. No statement related to the annual report must be signed by the CEO and CFO as the following. Disclosure has been made to the auditor, the audit committee of material fraud that involves management or any other employees with a significant role in internal control. All right, so I don't particularly like this one, but let's just answer it anyway. Is this SOX compliant? Sure sounds like it should be. The answer is no. Okay. So first of all, it's not got any information of the information with respect to significant deficiencies in internal controls, and it doesn't keep in mind that we're talking about fraud. Any fraud, regardless of materiality, that involves management or their employees, that has is going to be that has a significant role in internal controls has to be reported to the audit committee. So again, not every single fraud, but any fraud that involves management or employment does need to be reported, especially those, especially say management or employees who have a significant role in internal controls. So our position to influence internal controls, not just any employees. But yeah, it's not just material fraud. The audit report will contain a statement the management of internal audit function is responsible for establishing and maintaining adequate internal control over structure and procedures, not procedures for financial reporting. So my apologies, typo. This was a lot to type out, so there's going to be a typo here. What do you guys think? Are we in compliance here? In compliance with SOX? I got a thumbs up. We have more thumbs up. Everybody else being uncertain that they don't want to be wrong. That means you don't want to be right either. All right. You don't want to be right. This is a thumbs down. Thumbs down. What's wrong with this one? Who's responsible for establishing and maintaining adequate internal control in an organization? Management, not the internal audit function, not the internal audit function. Yeah. That was a trap. That was a trap. All right.
Wait, so it's not management of the internal audit function?
No, it's management of the organization.
Oh, that's okay.
So this was a trap. It was a trap. You got this question on the CPA exam, I think you should write it. Holcomb has always had a code of conduct for employees at all levels of the organization. The annual report, significant accounting policies, actually, tonight, James will discuss changes to or waivers from the code of conduct. What do you guys think? It's a good identification as the thumbs down. So this one's not one that I immediately expect you to know, but let's talk about it. If there are changes in the code of conduct, where does this need to be reported? An AK, yes, an AK. So one of those forms we have to know about. So yeah. Holcomb's audit firm has maintained work papers for audits for the past 9 years. What do you guys think? Yeah, we're good. Yeah, we're good in compliance. What is the threshold of time for that has to be held for under PCOB guidelines? 7 years. When do these have to be archived by? This recently changed, and we talked about it in class. Has to be archived within, I believe it's 14 days. Has to be archived within 2 weeks. Used to be 45 days, and they greatly reduced the time frame for that because people were taking too long. So yeah, 14 or 15 days. I believe it's 14 days. So yeah, forgive my memory. This is new information, and I'm really, really bad at absorbing information. All right, let's go ahead and do our fun last in-class CPA prep question. All right, so first and foremost, you guys can keep the sheets of paper out on you this time. This is my gift. If you choose to take notes on this, I encourage you to still do so, but if you encourage to take or choose to take notes, that's entirely up to you. Under the ethical standards of the profession, which is the following situations involving non-dependent members of the auditor's family is most likely to impair the auditor's independence. So again, this kind of clarifies non-dependent members, which we're talking about dependent relationships. That's going to be an immediately family member, or at least a close relative. So dependent children would be considered to be immediate family members. Dependents who are not children would be considered to be close relatives. Now the rules are anybody who's an immediate family member is going to be held to an independence guidelines as covered members. Anybody who's a close relative is held to that criteria if they have a direct and material interest or can exert significant influence over your client. Okay, so there's some specific guidelines. So a parent would be a close relative, not an immediate family member, and we said that has to be a direct and material interest, and they specifically say it's a immaterial investment. So the parent would not likely to be a violated independence. First cousin is neither an immediate family member or a close relative, so we can eliminate that. Spouse is an immediate family member. That's one of the client members. So employment of the client would definitely be a violation. So that would be the one that I identify pretty clearly. Siblings loaned to a director of a client. That's probably the next closest, but a sibling is considered to be a close relative and would need to be in a position to influence the client. This is going to be a loan to an individual within the company, not to the client themselves. So that's why it probably is not as clear as C. All right, a registered public accounting firm is conducting an audit of an issuer initiated its current year audit on January 1st, year 3. Many of the firm's former auditors are now employed by the client under which the following circumstances may the firm perform the audit. So this actually happens pretty regularly because auditors generally get good business relationships with their clients, and the client says, hey, if you ever decide to leave public accounting, then maybe you can come give us a try. And they hire a lot of their executives from the firms. Something to keep in mind when you go into the real world. But there are some PCOB guidelines for publicly traded companies, specifically this thing called a cooling off period. You cannot be on a client, you cannot work for a client that's an audit, or you cannot audit a client that's got individuals who have actually been employed with the accounting firm within a certain period of time. How long is the cooling off period? One year. Okay, 1 year. So we're looking for something. They're looking for examples that are greater than a year distant. So if we look at B, C, and D, these are all in year 2, various phases of year 2, and we're at the beginning of year 3. Those are all within 1 year, which means that they would violate the rules in which the auditor can perform the audit of clients. The only one that doesn't violate that is A, client CFO with the lead partner in the audit until December 31st, year 1. We have elapsed 1 year. But all right, enjoy your weekend. Best of luck in your preparation for presentations, and see you next week.
Thank you.